Hello friends. So today is the first ACC exam. Best of luck to all of you, right? We still have some days for AFM, so I thought of making this video. This video is made on request, right? Someone requested me, right, to make this video for her. So this video I'm making for her and also for all who are going to give AFM this December. So I have done a short summary of all the key points which you have to cover in AFM, right? This video will be divided into three parts, right? Because otherwise it will be very long. So this is divided into three parts, and this is the first part of it, right? AFM tools to pass. So these are some few areas where you need to master to pass AFM. So let's start. And while I go through the slides, move through the slides, don't forget to take a screenshot if you think that is relevant, right? So for you to remember. So first we are going to start with the ratios, because AFM, when you enter, whether it's financial management, whether it's advanced financial management, you need to know these ratios. It's a must, right? That's why I have written as must know. So these are the few ratios I have taken from the textbook. If you have your BPP textbook, all the ratios are given there, but I have taken all the ratios here. So first I'm going to start with the profitability ratios, right? Going to AFM without knowing the ratios, it's not happening, guys. It's not happening. You need to know the ratios, right? Because your formula sheet, right? Yes, it's true that you will be given the formula sheet, but still this ratios you are not given, right? These ratios are from your assumed knowledge, right, of financial management or your previous studies, but it's not there in your AFM formula sheet. All these ratios are not there, so you need to memorize it. You need to know it. You need to know the formula, right, in case you need to apply. So first we'll start with profitability ratios. The first ratio which comes under profitability ratios, the most important, is return on capital employed, ROCE. So this is the formula. The formula is profit before interest and tax, PBIT, dividable capital employed. So your capital employed is, I have also written how you'll get the capital employed, right? It is the shareholders funds plus the long time liabilities, right? Shareholders funds you can take as your total assets minus current liabilities, right? And you add your long term liabilities, you will be getting a capital employed, right? And profit before interest and tax, you will get it from your income statement. Next, based on this, next is return on equity, right? Return on equity is, the formula is earnings divided by the shareholders equity, right? Next we have asset turnover. Asset is your sales divided by capital employed, right? For the capital employed, you can take the formula from the first, ROCE, right? Next we have gross profit margin, gross profit over sales. Then operating profit margin is profit before interest and tax, you have to take divide by sales, right? So these are few profitability ratios. Let's move on to the next set of ratios, which are your liquidity ratios, right? You must be very familiar with this ratio, so I'm quickly going to go over it without wasting so much of time. First we have current ratio, asset test ratio, receivable days, payment days, and inventory days, right? Next, the third set of ratios are your investment ratios. These are the most important ratios where you need to focus, right? Out of all the ratios, this one and the next set of ratios, these two types of ratios, more than the profitability, the liquidity ratios, the other two ratios are more important. You need to use it more frequently. But I'm not saying that the first two ratios are not important. Everything is important, right? First set of investment ratio, the total shareholder return. That is your dividend per share, right? Plus capital gain or loss. If it's a gain, you add. If it's a loss, you deduct. Divided by the share price at the start of the year, right? You multiply this by 100, you will get your total shareholder return. Next is your dividend yield, right? This is very important. You need to know the dividend. Write it somewhere, because dividend is, you need dividend throughout your AFM, right? Dividend yield, dividend cover, because AFM or your financial management is based on three decisions: investment decisions, financing decisions, sorry, a dividend decision. So these are the three key decisions of AFM or the financial management, right? So dividend yield, for dividend decisions you need dividend yield, dividend per share divided by market price per share. We have EPS, very important, earnings per share, right? Even if you don't, you might not use all the ratios, but EPS is a ratio which you will be using it. It could be used in your acquisitions, right? It could be used in your investment appraisal. It could be used anywhere throughout the, or it could be even asked in the theory part also, right? Then we have dividend cover. Now if you see dividend cover is EPS divided by dividend per share, right? So you need to know the formula for EPS if you want to find the dividend cover. It is linked. Next we have dividend payout ratios. So this, just check the before two ratios, EPS and dividend cover. It's just dividend cover divided by EPS, right? Wait, let me check the dividend payout ratios for a minute. Yeah, it's correct. It is, I'm sorry, it's not dividend cover, it is dividend per share divided by EPS. Yes, it is just the reciprocal of dividend cover if you see, right? Or in other words, 1 divided by dividend cover, you will get the dividend payout ratio, right? Just see the dividend cover and the dividend payout ratio. It's just the reciprocal of each other, right? Then we have PE ratio. PE ratio you need to know. PE ratio and your EPS, this two you need to know. There is no excuse, right? Next we go to debt and gearing ratios. So your financial gearing, right? Financial gearing is prior charge capital divided by equity capital, including reserves. But this is based on SOFP, statement of financial position values. You can also calculate financial gearing based on market value, right? You take the market value of prior charge capital and then market value of equity at the charge capital, right? This is the second one is based on market value. The first one was based on statement of financial value, right? Next we have operational gearing. So there are two types of gearing. One is financial gearing, one is operational gearing. Operational gearing is contribution divided by profit before interest and tax. Contribution is your sales minus variable cost. Make sure that you know it, right? In case you forget. Interest cover ratio, PBIT divided by interest. Debt ratio, what is debt ratio? Total debt to total assets, right? So these are some of the ratios, the four types of ratios: profitability, liquidity, investment, and debt gearing ratio. So make sure that you know, right? Especially the price earning ratio and the EPS. These two are the must. And these are the 5 main sections under your AFM. Section A, role of senior financial advisor. In this, you have the theory part. I have tried to summarize and write some important points where you need to focus some theory, but I haven't mentioned all. So make sure that you go through the textbook properly, right? Section B, advanced investment appraisal, right? Your net present value, adjusted present value, all comes here. And this is also a key question. Mostly if you see, it can come as a 50-mark question or as a 25-mark question, right? So you need to focus on this. That's why I have started, when I started my AFM classes, I started with section B first, because it is the lengthiest, it is the biggest chapter, it has so much of chapters, right? And also you will be getting a question on net present value or adjusted present value 100%, right? Section C, acquisition and mergers. D, reconstructions and reorganization, right? Reconstructions and reorganization is not something which comes regularly, but you might get, right? You cannot judge. There are sometimes you get, but most of the time it is section B, section C, and section E, your risk management. Section B, C, and E, and A comes throughout all the, right? It comes under all the questions, whether section A question, whether section B or section A or section B, right? So these are the 5 main sections, but in this video I'm only going to focus on section A and section B only. So this video is only going to cover section A and section B part. Section C and section D will come in part 2, and final is part 3. The final video, which will be section E, will come in the last, right? So you have to wait for tomorrow and day after tomorrow to get the two parts, right? Today I'm just going to release the first part. So role of senior financial advisor, let's go to section A, right? Section A is also very big. It's quite big, right? There are around 5 chapters there. So these are the theory parts you have to learn, but please make sure that these are not only the theory parts, right? Just because I have mentioned here, don't only go through this and forget about the rest, thinking that others are not important. No, it's not like that. It's your job to go through each and every theory part, check the exam paper, past paper, which theory is repeated, right? But this is based on my judgment, my idea, right? So first is behavioral finance. You need to know what is behavioral finance, right? Because this question has been even asked in 2020, right? For 8 marks. Then we have credit crunch. You need to know the credit crunch, the impact of it, how it happened and all. Securitization and tranching. You need to know the benefits and the risks of tranching. What is securitization, right? Dark pool trading. What is dark pool trading? What are the benefits? What are the advantages, disadvantages? You need to know all this. I'm not going to discuss here now. What are all these things? You must have read it. You must have known by now. Next, we have risk other than financial risk. Now, this is very important because most of the time, what we only focus as financial management student, we only focus on financial risk, financial risk, financial risk. What about other risk? When you discuss, when you write a report, when you recommend, for example, let's say mergers and acquisition, you're recommending whether you have to merge or not. Just based on one financial benefit or synergy benefit, you cannot say. There are other risks to add. If it's a different country, then it's a political risk is there. You need to talk about reputation risk, health risk, culture risk, legal risk, right? Technological risk. There are so many other types of risk which you can talk about, not just financial risk. So you need to know about those type of risk. And also your risk management from USBL, you know, right? The Thara model. Then we have ethics. Ethics is a question you will be expecting, right? 100%, there is no doubt about it. Ethics, you will get a question on ethics. Any paper in ACCA, you will get a question on ethics, right? So you have to learn your ethics, right? Don't ask me how to learn ethics. Just see your past paper, how the answer has been presented, how it looks like and how it goes like, right? Then we have the dividend capacity. To learn dividend capacity, you should know the format of FCFE, free cash flow to equity, right? You need to know that format for dividend capacity. And transfer pricing, right? There are many types of transfer pricing. You need to know the advantages and disadvantages and how each type of transfer pricing works. There are many types of transfer pricing, right? You need to know each one of them. I'm not going to sit here and do all and explain all, but you need to know it. Next we have section B. Let's move on to section B. Section is a very big section. I couldn't include all, right? If I include all, this video will be a never ending video. So I wanted to make it short and very the main idea, right? But you have to go through the other theory part also. Now let's go to section B, advanced investment appraisal. So let's start. These are the key areas which you must cover, right? I have gone by the chapter wise, through the chapter wise in BBB textbook. So first is positive net present value, accept the project, negative, reject. Next is effect of inflation. You need to show the effect of inflation on your net present value calculations, right? This you will be asked in the exam, and the inflation rate also you will be given in the exam. Next we have real cash flow. Without inflation, use real discount rate. Yes, when there are cash flows, right? It could be without inflation or with inflation. If it's without inflation, then you should use real discount rate. And if it's with inflation, then you should use nominal discount rate, right? But mostly it is the nominal cash flow only which we do with inflation. We inflate it and then we use a nominal discount rate. That's what we do, right? Then Use Fisher's equation to find real or nominal rate. Yes. When, right? There might be times that you must have seen that they have drawn up a table where they have calculated net present value using some discount rate, which you need to correct now, right? So in that time, maybe you need to find a real or a nominal rate. So you can find one rate if you know one rate, and what is the other thing which you need to know? Can anyone tell me in a Fisher's equation what is the other thing you need to know? You need to know the, what do you need to know? Inflation. You need to know the inflation exactly, right? You need to know the inflation to find, if you have the inflation and if you have a real, you can find the nominal. If you have inflation or nominal, you can find the real. So one rate you can use, right? You can find, uses Fisher's equation. Fisher's equation is given in your formula sheet, so you don't have to memorize the formula. But if you memorize it, it's better so that you can work faster in the exam. Because I personally, I never have to look my formula sheet for my formulas because I was that much confident because I memorized all the formulas. Because it's not memorizing, but when I was working through it, the formula is already like it comes, you automatically it comes, you know what is it. So now next is effect of taxation. Assumptions will be given in the exam. There are three types of assumptions. Tax could be paid in the same year as the profit, or it could be paid 1 year later, or half this year, half next year. So any one of this will be given to you in the exam, right? The taxation. Whenever tax, you need to show the effect of taxation. We have done all this, right? You can check my videos also, my previous videos, if you want to refresh your knowledge on this part. And the important thing, don't forget, is your tax allowable depreciation. Most of you, when you calculate your tax allowable depreciation, here, this is the place where most of you can go wrong when you have to find the net present value. Rest all is still okay, but tax allowable depreciation and your working capital adjustments, right? I forgot to mention about working capital, but you write it somewhere, that working capital requirement when you have to find out that one, and tax allowable depreciation. These two things candidates do mistakes more often. These are the two places. So tax allowable depreciation could be based on straight line or reducing balance method. It will be given to you in the exam which method you have to use, but you should be comfortable under both the methods, right? Next, based on tax allowable depreciation also only, I want to elaborate more on that, is you have to state the assumptions, right? Whether tax allowable depreciation is from the first year or after 1 year, right? You have to state assumptions. Even if the examiner does not tell you to state assumptions, you always need to state assumptions, because your assumptions you will get marks, right? Let's say you are writing 4 to 5 assumptions, you will get 4 to 5 marks if your assumptions are, it, it's fine, it's reasonable. So never underestimate the power of assumptions, always state assumptions, right? Next, you need to know how to account for the balancing allowance or balancing charge in the last year. Remember when we used to do that table form, when we used to find the cash flows and all, right? That time, there was a balancing allowance or charge which comes at the end, right? And most of you even make a mistake in this part, in that balancing allowance or charge, right? So it's very simple. Let me give you an example. Let's say an asset, right? A plant and machinery which you have been holding, it is sold in the last year, right? It will be sold in the last year for 5,000, right? And your reducing balance at the end, right after, it's a reducing balance method, right? And your tax allowable depreciation, right? Your last reducing balance method, okay, the last year says, let's say it is 9,000, right? And you have been sold for 5,000. So your sell value is less than your reducing balance method, right? Your reducing balance the last years, right? Let's say it's 9,000 and your sale is 5,000. So if your sale is less than it, then there's a balancing allowance. The difference is the balancing allowance, the sale and the reducing balance. It's like when you add all your what? Tax allowable depreciation. All the years. Deduct it from your opening, deduct it from your, let's say, plant and machinery, right? Finally, you should be getting a zero. Your balance has to be zero at the end. Then you will know that your tax allowable depreciation calculation for each year is correct, right? So just see how it works. Go through the tax allowable depreciation questions and go and check in detail how it is, right? I will not be able to show here now, but go and check. Need to calculate tax saved or tax paid. When it's a tax allowable depreciation, it's a tax saved. You're saving tax. You need to calculate that also. Tax, or it could be tax paid also, right? In some cases. So you need to calculate that, right? Next, this is very important. This is the key, right? Tax allowable depreciation is deducted to find taxable profit, right? You deduct this to find taxable profit, where first you take your sales revenue, right, and you deduct your cost. From that again you deduct your tax allowable depreciation to find your taxable profit, right? And on that you find tax also, right? Again you need to add back your taxable allowable depreciation, right? From your taxable profit you deduct your tax. Again you have to add back your taxable tax allowable depreciation, your TAD, to get your cash flows. Remember to add back when you deduct. Don't forget to add back again. You need to add back again to find cash flows, right? Next, multi-period capital rationing. Use linear programming, right? And your main thing is you don't have to solve linear programming. You just have to know how to set up the objective, how to set up the constraints and all those things. So just go through that. It's not very lengthy. I think it's just one page, right? And it's very easy to understand. You don't have to solve it. So that's a good thing. You don't have to solve the equation, but you need to know how to set up a linear, right? Set up the equations using linear programming when a multi-period capital rationing is given. Also for the theory part, you need to know what is soft and hard rationing, right? Soft is internal factors, hard is external factors. You need to know this when you are told to explain the theory part. Next, we have expected value of project calculation, right? Expected value is when you are given some probability and you have to multiply, right? Multiply what? That's a question, right? Multiply the present value, right? Expected net present value. In fact, in 2020, we have even done a question also on that. The last question was something like that. Expected value, net present value, right? Based on some recession came and then expected value. So expected value, when you need to find, you will be given some probabilities and your present values, right? And then you have to find your expected value. Expected value is the sum of all the probabilities multiplied by your present value, right? Higher the expected value, better it is. Lower the expected value is not good. Next is sensitivity analysis, calculations and its weakness. You should know how to calculate sensitivity analysis, and also its weaknesses you need to know, because sensitivity analysis you always recommend, right? Whenever some project investment appraisal question comes up, finally when you make a report, in your recommendation you write that, right? It's better to carry out sensitivity analysis, right? So you need to know something about it, its weaknesses, its strengths, its calculations and all. I'm not going to show calculations here. I have already done it in my earlier videos. You can please go and check. But you need to, but I'm just giving you the idea that these are the things you should know. Next, we have project duration, right? Make sure that you know how to calculate the project duration, right? So project duration is basically the percentage of the present value for a year divided by the total present value, right? You will get some percentage for each year. You multiply the percentage by the number of year, add all, that will be your project duration, right? Lower the project duration, better it is. Next, value at risk. Value at risk you will always be given at 1% or at 5%, not at different, right? Mostly you are asked at 1 and 5%. So this is the rate, right? You don't have to memorize from the table. You just memorize these two numbers. It will save your time, right? Otherwise, you can get this figure from the table also, but it will cost more time. So if it's at 1%, it is 2.33 multiplied by standard deviation. And if it's at 5%, it is 1.645 multiplied by your standard deviation. Standard deviation will be given to you in the exam. Or, and one more thing is, in case you might be given variance, right? It's not always that directly you'll be given standard deviation. There are cases where you are given variance. What do you have to do? You have to find the standard deviation, right? Square root of variance is the standard deviation. So that you will be given, right? Either standard deviation or variance you will be given. Now project value at risk. This is the formula, right? I have written this formula down for you here so that you can take it down, right? Everything on one shot rather than going back and referring to your textbook, because these formulas are not there in your formula sheet. You have to memorize it, right? And one more thing, when you're given value at risk is, just make sure whether you are able to understand the way they ask. They could ask value at risk at 1% probability, or they could ask at 99% confidence level, right? 99% confidence level or 1% probability is the same thing. 95% confidence level and 5% probability is the same thing. So don't get confused by the confidence level and the probability. Make sure that you know how to interpret the question. Next is PVAR, project value at risk, is K multiplied by standard deviation. What is K? K could be 2.33 or 1.645 based on your probabilities, 1 or 5%, right? And your N, okay, square root of N is the number of years. Let's say a project has a 10-year, right? You need to find a value at risk for a 10-year project. Then it will be square root of 10, number of years. So this is the formula. Next we have IRR and MIRR. Formulas are given there, memorize it, right? There are, and also you need to know the limitations of IRR, what are the advantages of MIRR, and all those things, right? So make sure that you know it, right? And IRR formula is not given there, that you have to know, right? The interpolation method. MIRR is given there, but IRR formula is not there. Make sure that you know the interpolation method of IRR. Comparison of net present value and IRR. You need to compare net present value and IRR, right? Which one is the superior method if you have to compare? I would say it's a net present value, right? Net present value is a superior method compared to IRR, because net present value and MIRR is giving you a similar answer. But IRR is not, because IRR they divide it by the IRR rate, but MIRR and net present value they take cost of capital as a discount factor. Next, Black-Scholes pricing model. Black-Scholes pricing model formula is given there, right? You have to do enough of calculations so that you are able to quickly calculate it, right? You need to be very fast in calculating these things. Whenever calculation part comes, you need to work very fast, right? When you Black-Scholes pricing model, you need to take care about 4 things. First thing is D1 and D2. When you calculate, it needs to be round up to 2 decimal places, only 2 decimal places, not 1 decimal place, not 3 decimal place, only 2 decimal places. Why, you might be asking? Because when you go to the table to find the probability, right, that value ND1 and ND2 from the table, you will be seeing that it is only for up to 2 decimal places only. And make sure that you know how to use the standard normal distribution table. You need to use the standard normal distribution table at this point, right? So when you use the standard normal distribution table, make sure you know how to read it. First you have to take from what? From the column side, right? Then you have to take from the, first you have to take on the, what is that called, y-axis. Then you have to go by the x-axis. So you make sure that you know how to use the standard normal distribution table. Check yourself. Don't just go by the answer which is given in the book when you calculate D1 and D2. Third, very important. This third and fourth is very important, right? Sometimes knowing very little, right? This little things, if you pay attention, can make a big difference to your exam result. Trust me on this. You don't have to do something very big or very major, very significant to have a big impact. Little changes you do, take care of details, small things, it will make a big impact. That's what I always emphasize students, right? So first one is if D1 or D2, any one of this is, if it's greater than 0, right, you will be getting D1 or D2 based on the formula. The formula is given in the formula sheet, so I'm not writing the formula here. I'm only writing the formulas where the formulas are not given in the formula sheet and you need to memorize. So that is very easy for you to access. You can even take a picture of it or you can write it somewhere down. And don't forget to share this with your friends, right? Exams are just 3 days, right, on 11th. So make sure that you go through the small little things, okay? If D1 or D2 is greater than 0, add 0.5 to the relevant number. Some number you will be getting based on the standard normal distribution table. Let's say it is 0.58 something. It will be up to 4 decimal places, right? That number, add 0.5 to that. That will be your ND1 or ND2. But what happens if it's the other way around? If D1 or D2 is less than 0, means it's a negative number, right? There are chances that you can get a negative number also. In the first one, it's a positive number. You add 0.5. If it's a negative number, less than 0, right? That time, you have to minus that number from 0.5. 0.5 minus that number, right? So you will be getting, amount will be less than 0.5 only totally, right? The ND1 or ND2. So this things you need to take care about. Next, let's go to the limitations of net present value. What are the two limitations of net present value? You need to know it. First is, it does not deal with uncertainty, right? It's lacking. Second is flexibility. It's not flexible to respond to uncertainty. Net present value only gives you one figure, one fixed figure. Let's say net present value is 10,000, like positive 10,000. Only one figure they are taking, right? There are so many uncertainties. It could be less than that. It could be more than that. It's an uncertainty. Net present value is not good in dealing with that uncertainty. And also they are not flexible in responding to uncertainty. Then what happens? What comes to the picture? Because there are limitations, then comes the real options. You need to know real options. You cannot forget about real options, right? So when you go to the real options, you need to take up that there are 4 options. Make sure that you know what are the 4 options. Option to delay, option to expand, option to abandon or withdraw, option to redeploy. These are the 4 real options. And first 2 options, option to delay and options to expand, are call option. And option to withdraw or option to redeploy, the third and the fourth one, are put option. That also you should know. You should know which one is a call option and which one is a put option. Why? Why you have to know? Because if you know, then only you can find the value using what? Using Black-Scholes model. Exactly. It does not matter whether it's an option or a real option. You should use Black-Scholes model only. And by the way, when I refer to options or real options, I'm not mentioning about the financial options which we use for hedging. So don't get confused with these options and the hedging options, right? The options where we pay premium, we hedge interest risk, currency risk. I'm not talking about that option. That option is different. This option is different, right? So real option also you have to use Black-Scholes model. Using Black-Scholes model, you have to value. If you messed up with call and put, your valuation which you use using Black-Scholes model will also be messed up, fully messed up. So don't make that mistake, right? Next, assumptions of Black-Scholes model. What are the assumptions? There are 5 assumptions of Black-Scholes model which you need to know, right? Go through those assumptions. Still there are few days, there are time, you can go over it. You must have done it, but again just go through it just for refreshing, right? Next, Islamic finance, right? So much in detail you don't have to know. There are so many products in Islamic finance, sukuk, ishara, ijara, right? Riba. There are so many things are there, but make sure that you know at least the basic. You don't have to know so much in detail. You will not be asked a calculation on this, only theory part. So make sure what are the advantages, what are the disadvantages, what are the features of Islamic finance. Make sure that you know. Make sure that you know how to compare Islamic finance with conventional finance, right? Conventional method of finance, right? For example, Islamic finance does not allow speculation, right? You cannot speculate, you cannot bet, you cannot earn interest because it's haram. So, but in conventional finance, you can speculate. So these are some differences which you need to know. Next, we have cost of capital. Very, very important. Whether it's for investment appraisal, right? It could be for mergers and acquisition. It could be for anything. It could be for your reconstruction or reorganizations also. But cost of capital, you need to know. What is cost of capital? I've written down also. I broke down and I wrote down cost of equity plus cost of debt. Why? Because cost of equity separately you have to find, cost of debt separately you have to find. Add both, you will get the cost of capital. Why you need the cost of capital? Because your cost of capital is your discounting factor. When you have to discount a project, when your discounting factor, whether real or nominal, is not given to you, how will you discount? How will you get the net present value? There you have to find cost of capital. There you have to find cost of capital. To find cost of capital, you need to know cost of equity and cost of debt, right? And there are a list of that also which I have written, so don't worry about it. Cost of equity. First, I'm going to focus about cost of equity. Then I will talk about cost of debt. So cost of equity. How you will calculate cost of equity based on dividend growth model. Dividend growth model formula is given there. Formula sheet, right? What is the dividend growth model? Dividend means whenever dividend word is there, right? Dividend is linked to equity. Because dividend you will pay to whom? To whom do you pay dividend? You pay dividend to shareholders, ordinary shareholders, right? So equity, right? Equity holders. So your dividend and your equity are linked. That's why you're using dividend growth model for cost of equity, right? Now you can see when you're in a doubt what to use to find cost of equity. You can use dividend growth model. Just a link like that, dividend and equity. Next we have estimating growth rate, right? Dividend growth model. What happens? Under dividend you might be given all the components, all the elements, but growth you are not given. Growth you have to estimate, you have to figure out what is the growth. So also I have written down the formula when you have to find the growth rate. The formula is newest dividend divided by oldest dividend. What is newest dividend, oldest dividend means? Here also you can make a mistake. Let me clear this out first. Let's say you are given a cash flow for 4 years, right? Let's start from 2000 to 2004. 2000 2004, right? So the oldest dividend is 2000 and the newest dividend is 2004, right? You cannot compare 2003 and 4. You cannot say newest dividend is 2004 and oldest dividend is 2003. It's not 1 year difference, so don't make that mistake. Oldest is the first one, 2000. Newest is 2004. So 2004's dividend divided by 2000's dividend, the first dividend and the last dividend. Take that to the power of n. N is your number of year. Let's say if it's for 4 year or 5 year. And minus 1, bring the 1 the other side so that you can get the G. G is your growth rate. That's what you want, right? And make sure when you find this way, right, that to the power of n. I know most of you will not be able to calculate it because in the calculator you should know how to find it out. Dear, what you should do now? You should know how to find in the calculator. So make sure that your calculator is always with you. You know each and every step. Work out on your calculator and check that you know how to calculate, right? You should be able to calculate this on your calculator and check your answer. Because if you don't know how to use calculator, then even if you know something, you will not get the correct answer. You will struggle there. So don't be the one who struggle there on the exam day. Okay, and the second method of estimating growth rate is Gordon's growth model. This formula is also given there, which is G into BRE. What is G? G is the, right? RE is the retention rate. Right? G is equals to BRE. So Gordon's growth model, and the other one is this. Out of this two method, you can use any one method and find out the growth rate. And the third one, right? Not the third one, this is the second method of finding cost of equity is your CAPM, capital asset pricing model. We all know what is the capital asset pricing model. I'm not writing that formula, right? So first one is dividend growth model, second is CAPM. Out of this two method, you can find your cost of equity, right? Next, cost of debt. Please pay attention to cost of debt, because cost of debt is the one where most of you make mistakes. Cost of equity is still lazy, right? You will be able to find cost of equity. Most of you do it correctly. Cost of debt, you make a mistake because there are many types of debt over there. Redeemable, irredeemable, convertible debt. You need to be confident in all the types of debt. You cannot say this one is more important than this one. I have even placed them in a hierarchy also in order, right? Valuing redeemable bonds. Most of the time, redeemable bond you are asked, right? And it has many calculations to do. So this is the formula when you have to value a redeemable bond. Value of debt is equals to interest into annuity factor plus redemption value into discount cash flow, right? So value of debt, first let's take the first portion, the interest portion, interest into annuity factor. Let's take a debt. Debt means loan. Let's take a loan or a bond, whatever it is. You have to pay interest what, annually, right? So that's why interest into annuity factor, because interest is fixed. You are paying fixed interest, same interest which you are paying annually, let's say for 5 years. So that's why you are taking interest into annuity factor. Got it? Plus, you are just not paying the interest. You are also paying the capital, the value, the capital amount, the principal amount, right? The redemption value. It is known as redemption value when it comes to bond. So redemption value, let's say you're taking 1,000, right? $1,000 bonds at a 5% interest. So 5% for 5 years, and redemption value will be 1,000, right? So 1,000 into discounted cash flow, discounted factor, right? So that's how you will get the value of a debt, which is the market value of a redeemable bond. You can say market value also. Add yield to maturity. Use IRR. You know how to use IRR. You should know how to use IRR. Use that method to find yield to maturity, right? Now you must be asking that why you have to do that, right? Yield to maturity. Because yield to maturity only is the cost of redeemable debt. That percentage you want to find out. That is the percentage. Yield to maturity. So for yield to maturity, you have to use IRR, right? Let's say you are discounting using 10%, okay? 10% you are given. So just take another one. It could be 5% or 9%, anything, just take trial and error, right? IRR. So based on this, you can find an IRR. You will be, right? Based on IRR, you will be getting one rate. So that rate is your cost of redeemable debt, right? So that one is your cost of redeemable debt that you have to take as a percentage, right? Next, let's go to irredeemable debt. Redeemable debt is over. Now let's go to irredeemable debt. Just excuse me for 1 minute. Okay, so now let's come back. Irredeemable debt, right? Irredeemable debt, this is the formula, okay? So I into 1 minus t divided by P0, okay? T is your tax, I is your interest rate, and it is assumed that irredeemable debt, right? The interest is paid in perpetuity, right? So interest and the tax, right? And your P0 is the current X interest price. So you should know how to value the irredeemable and redeemable debt. It's different. The calculation is different. So make sure whether it's redeemable or irredeemable. Check in your question. Next, the third type is convertible debt. Right? This is not very difficult. It looks difficult, but it's not difficult. The word convertible itself makes you feel that it's very complex. It's too much of working, something very difficult. No need to worry. It's not like that. Right? So for you have written down the formula also, convertible debt, right? You need to find the conversion value. Whenever convertible debt is there, conversion value you have to find out. The formula is P0 into 1 plus GG is the growth rate to the power of what? N, right? N is the number of years to conversion. Let's say it's 2 years to convert, then is 2 years. R is the number of shares received on conversion, right? Convertible debt means the debt will be converted to equity. So when it's converted to equity, you'll be getting shares. So that R is that number of shares on conversion. When you know this, then it's very easy for you, right? Everything else, the way you calculate, right? The way you calculate the redeemable bond, right? The value of the debt and the yield to maturity to find the cost of debt. Everything is the same. Here also you have to use IRR to find the cost of debt, right? Cost of convertible debt. The only difference comes as in the final year, right? Final year is your not the principal value, not the redemption value. This is conversion value this time. That is the only difference. It comes as the conversion value, right? So that is the only difference which comes. Rest all everything remains the same. Just do one question and see. You can refer to page 213 of your BPP textbook and see, right? With your redeemable bond and convertible bond, everything is same except it is not a redemption value. It is conversion value which you are taking. Next we have cost of preference share, right? Preference share is not asked, but it's better to know the formula in case if you are given preference share, right? So preference share is D divided by P0. What is D? It is dividend payments. D is dividend payments in perpetuity, right? Whenever preference share, ordinary share comes, dividend will come to your dividend will come in the picture. Next is WACC. Right? WACC formula is given. Make sure that you know what is WACC formula because now we have cost of equity and cost of debt. So next is WACC. Calculation of WACC. Gearing and ungearing betas. Right? Please focus. You need to focus very, very deeply. You have to focus here. This is a key. If you are bad, if you're not good in gearing and ungearing at this stage, if I'm asking today, do you know how to gear? Do you know how to re-gear, ungear? If you don't know, then don't go to AFM exam. There is no use of you going to AFM exam if you don't know gearing and ungearing. You cannot expect a question where ungearing and re-gearing will not be asked. You will be asked a question somewhere where gearing and ungearing will be there. Right? I have divided it into steps. These are the steps whenever you have to gear and ungear betas, what do you have to do? So first step is step number 1. Take a proxy company's equity beta. Just check. The word equity beta should be written there. Right? Take a proxy company's equity beta. That is number 1 step. Proxy company means similar company. They will tell you this company's activity is similar to your company and their equity beta is like this. Something like this will be given to you. Take that beta. Step 1. Step 2. Find the asset beta using our company's capital structure. R means the company in your exam which you will get, your company, their organization. Let's say the capital structure of that company is 30-70. 30% is debt, 70% equity. So based on that ratio, you have to find the asset beta. How will you find the asset beta? Using the equity beta of the proxy company. From step 1, you are taking the equity beta, putting in the formula and finding asset beta. Right? Finding asset beta. Step 3 comes is find equity beta using formula. Once you find the asset beta using the formula, right, using your capital structure, debt equity ratios. Next, once you find the asset beta, now you can find the equity beta also using the formula. So what do you have to do? Find the equity beta. Find the equity beta. Right? Once you have find the equity beta, next just use the equity beta in the CAPM and find the cost of equity. And then then you can use it in your WACC. Right? That cost of equity you can use in your WACC. And cost of debt in your WACC and find the WACC. Now you also need to know there are weaknesses in this formula for finding equity beta. There are problems, weaknesses of finding your equity beta like this, in this way. Taking a proxy company's equity beta and putting in your capital structure, adjusting in your capital structure, there are weaknesses. Make sure that you know those weaknesses. Calculating duration or Macchiolo duration. It could be called as just duration or Macchiolo duration. Both are same only. If they just ask duration or Macchiolo, it's the same, right? No difference. You need to know how to calculate it, right? This is the formula. Sum of the percentage present value in each year by each year. Let's say for year 1, 50% present value. Year 2, 20%. So first year, 50% multiplied by 1 because first year. Second year, 20% multiplied by 2 because second year. And then third year, fourth year, like that it goes on. Add all, that will be your Macaulay duration. That is the formula. Properties of duration. You need to know properties of duration. Modified duration. What is modified duration? Macaulay duration or duration divided by 1 plus GRE. What is GRE? Gross redemption yield. Right? That is your Macaulay duration. And you need to know the properties, advantages and limitations of modified duration, and also the convex relationship. There was a diagram also, right? That which you have to draw. So that diagram, right, on page 223 of BPP textbook, there's a diagram. Go through that diagram, the convex relationship. That's a limitation of modified duration. Make sure that you go through it. Next we have credit ratings. You should know how the credit rating works from AAA versus A, right? So which one is better, AAA or A? AAA is better, right? AAA is having a better credit rating compared to A. Because that means AAA is less riskier than A. A is more risky, right? Next, credit migration. Credit ratings does not stay the same. It changes. It could go up or it could go down. Maybe it could become better. It could become worse. Let's say A is becoming better, right? The risk is reducing and it's going to double A. So it could happen like that. That credit migration. Next is credit spread will be given in the exam, right? Credit spread is the basis point. Let's say right, higher the credit spread, more riskier it is, right? Riskier once, let's say the triple C or triple B will be having higher basis point, higher credit spread compared to the triple A, right? So this formula you should know. What is the yield on corporate bond? Risk-free rate which will be given to you plus the credit spread based on the table. The table you have to use a table to find that credit spread. Next, adjustments need to be made sometimes. Okay, let me tell you when you have to make these adjustments. Right, there are sometimes where you have to make some adjustments. Let's say in the table you have to find a credit spread for 15 years bond, right? But for 15-year bond you are not given any credit ratings, right? Let's say it's given for 1, 2, 3, 5, 7 and 10 and then 30, but 15 year is not given. That time you have to make some adjustments, right? So make sure that you know how to make that adjustment, right? On page 229, example 2, just check the solution how they have adjusted. Next we have cost of debt capital. When credit spread is given, this is how your debt capital will look like. 1 minus tax rate. You have to take account of the tax into risk-free rate plus credit spread. Impact of credit spreads on bond values. This you need to know. You need to know this, right? This means that what happens when your credit spread increases or decreases, what happens to your bond value. All right, that you need to know. right? Next, theories of capital structure. These are the theories of capital structure. You don't have to know so much in detail, but if you are asked to explain in theory, at least you should know something. Traditional view of WACC, net operating income view of WACC, theory adjusted for taxation. The third one, you are asked most of the time in terms of hedging, rationale for hedging when you have to hedge. That time, this theory is being mentioned a lot. So make sure you go through this capital structure. Next, we have weaknesses of theory. What are the weaknesses? You need to take account of that also. Alternative theories of capital structure. Alternatives are static trade-off theory where they talk about direct and indirect financial distress cost. Next, we have agency theory. Agency could be for agency cost of debt and agency cost of equity. Both you need to talk about. Next, pecking order theory. What does pecking order theory say? Pecking order theory says when you go for a finance, right? When you need finance first, right? First, you will be looking at your retained earnings, internal, right? Next, you will be going for debt, and finally, your last resort will be equity. Equity you are touching at the end, right? So first is retained earnings, second is debt, third is equity. That is a pecking order theory. Next is APV calculation, adjusted present value calculation. Make sure that you are very thorough with this calculation, right? Because adjusted present value calculation is not there in AFM, right? F9. So whatever there is not in F9, they make sure that they cover in AFM, right? All the advanced levels. So we have step 1, right? I have written down the step when you have to find the APV calculation, how you have to calculate. Step 1, first you have to calculate the base case net present value. That means, that shows that net present value you anyway have to know how to calculate or not. Whether under adjusted present value or under net present value. Net present value you should know how to calculate. You should know that table to make that table, or use rulers, right? Please use rulers when you make the table. Your work should be neat, right? So find the base case net present value that you could do. Main thing is assuming project as all equity financed. All equity financed. You are not taking debt into account. Debt you are taking in step 2. You have to assume it as it's all equity financed. All equity finance means what? Ungeared. Ungeared. So you have to find the ungeared cost of equity. Right? There's a formula also to find that. Based on theory with tax, there's a formula given in formula sheet to find cost of equity for geared and ungeared company. So you have to find that ungeared, right? That cost of equity you have to use. You're not using cost of capital because this is all equity finance. You are using cost of equity here. Step 2, make adjustments to allow for the effects of financing. Now you are making adjustments in step 2. Step 2 is the place where you are making changes. You are doing lots of calculations and workings. If tax, and this is one more thing which I want to make clear to you, that if your tax is paid after 1 year, right? Let's say tax is not paid in the same year, it is paid after a year. Then even your tax savings will also be after 1 year, right? Next, elements of, what are the elements in APB calculation? Issue cost, right? 5 divided by 95. Why I wrote 5 over 95 is I wanted to tell you that if your issue cost, let's say, is 5% of, right? Let's say there's a question that they say that issue cost is 5%, right? So if it is 5%, you are not taking 5 over 100, you are taking 5 over 95. Whenever issue cost is given, let's say now they are giving 6%, then it will be 6 over 94, right? So that's how your issue cost you have to take as a percentage. Next, and also when you take issue cost, you have to you have to take care of the tax effect also. You have to pay tax on that. So you have to multiply that by tax rate. The issue cost multiply your tax rate, also discount it, right? Spare debt capacity. Spare debt capacity, right? Spare debt capacity, when your debt capacity is increasing, right? That increasing amount you are finding. Let's say now currently debt is 2 million, but it has increased by 6 million. Buy 6 million means that increase amount you are taking, increasing amount, not 8, not 2 plus 6, 8 you are taking 6 million. Buy. If the question says that debt increased from 2 million to 2, not buy 2 million to 6 million. So what is the difference? 6 and 2, 4. So you are taking 4. You are taking the increasing amount, not the final increased amount, right? I hope you can follow through my words. Just by having a difference of one word, by, to, makes a lot of difference. So spare debt capacity is that increasing amount multiply by the interest rate, right? Take the tax rate and the discount factor, right? If you have to find the present value. Let's go to the subsidy. Subsidy, you need to take care of two things when you talk about subsidy. First is subsidy has two benefits. One is because of subsidy you are paying lower interest now. So there's a low interest benefit that you have to calculate. Second is tax saving. You are saving tax because of subsidy. That also you have to calculate. So there are two benefits of subsidy. Next, FC. Also you need to learn advantages and disadvantages. In fact, if you learn any model, whether net present value, adjusted present value, any method, any model, you need to know the features, you need to know the limitations and advantages. That I don't have to keep on reminding to you, and I'm writing it also. Next, let's come to the free cash flow. FCF. If constant growth, if constant growth, then multiply by 1 plus G. What multiply by 1 point G? The FCF, the free cash flow, multiply by 1 plus G, the growth rate. If the growth is constant, it could be different also. Now FCFE, you need to know the difference between FCF and FCFE, free cash flow and free cash flow to equity. I'm not writing down all the formulas. Formulas are there on your book. Make sure that you go through the formula, right? So free cash flow to equity can be calculated using direct or indirect method of calculation. You need to know both the methods. Valuation of equity. How do you value equity? That you have to know. It could be asset based on your assets, right? There are many ways of calculating equity. You need to know all the methods. So for first method, one of the method is asset based method, right? Where you are taking your tangible assets, right? Net tangible assets divided by number of shares. That is your value. You are not taking goodwill. You are not taking any intangible assets or goodwill which cannot be valued or which does not have a market value. If it has a market value, then only you can include it. Otherwise, you cannot include goodwill or tangible assets. They should have a market value. Like patents and copyrights, you can include because they can be sold. They have a market value, right? Next, you need to know the advantages and disadvantages of each method, by the way, right? Next is PE ratio earnings method for valuation, right? So PE, you know the formula. EPS, you know the formula. Market valuation is your EPS into your PE ratio, right? Or your PE ratio into total earnings. You will get the market capital valuation. Higher the PE ratio, better it is. Higher the price, right? So you need to know your EPS and market value. EPS and PE ratio, right? Next, there's another method. This is known as earnings yield valuation method, right? Which is EY. EY is earnings yield equal to EPS divided by market value per share, or market value is equal to. So finally, when you have to know the market value, that is earnings divided by EY, earnings yield. So earnings divided by earnings yield will give you the market value. Finally, what you have to know is how to find the market value. Dividend growth model, right? Whenever equity comes, I told you dividend comes into the picture. So dividend growth model also, right? You need to know the advantages and disadvantages. Next, free cash flow to equity, FCFE, is also a way of valuing equity because equity is there, right? Next, valuation using FCF, free cash flow. You need to know how to value using free cash flow, right? If no growth, then FCF divided by cost of capital. This you have to know. What happens when there's a growth? What happens there's no growth? So if there's no growth, just divide by cost of capital. But if there's a growth, multiply by the growth rate and divide by K minus G. K is your cost of capital, G is your growth. Terminal values needs to be discounted. What are terminal values? You must be seen that at the end there are some values that tell that after 4th year onwards, right? The cash flow will be this amount, right? Or it will be increasing at this rate, something like this will be. So then you have to find the terminal value, because free cash flow is your present value of your free cash flow plus your terminal value. You need to find the present value of your terminal values also. Add both, you will get the valuation using free cash flow. Now let's go to international investment, right? So this is the last topic, international investment, which is chapter 8 from your textbook. With this, we'll be over with section B. So international investment use PPP, purchasing power parity, to find exchange rates, right? You should know how to find the purchasing power parity to find exchange rates. Why? Because international investment overseas, you need to convert, you need to find exchange rate. If you don't find exchange rate, how will you convert to your home currency, right? Because international investment, their net present value will be in their currency. You need to convert in your currency. To convert in your home currency, you need exchange rates. To need exchange rates, you need to use what? Purchasing power parity, right? Formula is given, so you don't have to worry, right? Next, you can use interest rate parity, also IRP. Then international Fisher effect to find discount rate. Now is the time for you to find international Fisher effect, right? Let's say you want to find the discount rate, right? Because it's in your home, it's not in your home country now, it's in international currency. You are receiving foreign currency, net present value. So now let's say you want to discount it using what? First, you are converting to your home currency. Now you want to discount it using your home currency, but you don't know the discount rate. You only know the discount rate of their currency, that foreign currency. You don't know in your currency what is the discount rate. It's very easy. You can work it out using international Fisher's effect. You can find your discount rate. Or if you want to find the foreign country's discount rate, let's say your discount rate is given, you want to find the foreign country's discount rate, that also you can find using international Fisher's effect. So that's why this equation is there, to find the discount rate, right? You will be given the inflation of both the countries and interest of both the countries, like interest of one of the countries, the interest rate of one of the country. Or you would give, or you might be given the interest rate of both the countries and inflation of one country. In any way you can find the rate. Let's go to calculate net present value using both approach. What both approach? You need to find you need to be comfortable, right? You don't have to do both approach under the exam condition, only one, but you need to know how to calculate both approach. So first approach could be, right, focus the foreign currency cash flows, right? So you have to focus the exchange rates, and therefore the home currency cash flows. You are converting to home currency, right? Basically the foreign currency you are using, you have to use exchange rate, because you are converting all the cash flows to your home currency, and then you are using your domestic cost of capital to discount it. That is first approach, right? Second approach could be, and mostly we apply the first approach only, right? If you see, first approach is used even in the exam. Second approach is, here you don't have to predict the exchange rates. You don't need exchange rates. In their currency only you will deal. You will deal in foreign currency, keep everything. You will discount the foreign currency's cash flow using foreign currency's cost of capital only. Finally, that net present value which you calculate, that net present value only you will convert to your home currency using what? Spot exchange rate. But mostly we follow the first, right? Where line by line we convert to home currency. That means we have to predict exchange rate using purchasing power parity or interest rate parity. Effect on exports. You need to know the effect on exports, right? Tax. There are many types of tax which you need to take care of when it's for the overseas project, right? It could be corporate tax in the host country, investment allowances, withholding tax, a double taxation relief, foreign tax credit, right? All these things. Next, same way to approach adjusted present value. Adjusted present value when you have to find for the international, right? Not domestic, international. It's the same way only, the way you apply for the domestic. So I'm not repeating the steps again. And You need to know the translation, the transaction, and the economic risk. Why? Because there's a risk, right? Because of this international investment, there's a risk. It could be any of this risk. It could be transaction, it could be translation, it could be economic risk. You need to know all this type of risk, and also you need to know how to hedge economic risk. There are ways of hedging economic risk. You need to know it, right? Transaction risk, you don't have to worry about it, because transaction risk is we are covering in the last section, which is your risk management. We are hedging, right, using forward options, futures, swaps. That is transaction risk we are hedging. So that whole thing we'll cover later, right? Ways of hedging now, ways of hedging economic risk. There are 4 ways of hedging economic risk given on page 281. Go through it. Then advantages and disadvantages of borrowing internationally, right? You need to know you need to know the risk and advantages, right? Such as the euro currency market, the syndicated loans, the International Monetary Fund, and finally, choice of finance for overseas investment. What are the choice? What are the issues when you have to finance an overseas investment? You have to know those issues. You need to talk about those issues and how you are going to choose a finance, right? A way of financing for overseas investment. You need to take care whether debt, whether equity, whether you are going to borrow internationally. This you need to take into account, right? So that's it for this part. Hope you liked it and hope it's useful for you. Please put that thumbs up if you find it useful, so that I know that you like the video and I keep on making more of videos like this, right? My main purpose is this should be helpful for you, right, in the long run. So these are all the important things, and I will be coming up with the second part and third part of this soon, right? Tomorrow and day after tomorrow. So don't forget to watch my videos. Do subscribe to my channel if you haven't subscribed to my channel. And best of luck to all the ACCA students who are watching my video out there. Best of luck and take care.